All right, let's start with the next topic. Before moving to the credits chapter, I just wanted to clear out the calculation where I've received so many doubts on this calculation. How to do the Kiddie tax calculation. It's very simple actually. Whenever you are claiming a child, okay, on your tax return, and if the child is earning some income, it can be earned or unearned income. If the child is less than 18 or less than 24 plus a full-time student, then you can go for a Kiddie tax calculation. It's very simple. Net unearned income of a dependent child under 18 years of age should be taxable at their parents' tax rate. Okay, parents' marginal rate, just unearned income. Now, unearned income will include your interest, dividend, all the passive incomes. Okay, now the thing is, they will receive a deduction on the net unearned income. How it is calculated? Net unearned income is calculated by taking the child's total unearned income, which includes dividend, interest, rent, royalties, all the passive income, subtracting 2500. How the 2500 you have to subtract? 1250 is a standard deduction for unearned income, and 1250 is chargeable as at the child's marginal tax rate. So now do you understand what I was like talking about is total child's income. Okay, segregate it into two categories. One is how much is unearned and how much is earned. Okay, how much is unearned will first be allowed a standard deduction of 1250. The remaining amount will be chargeable to parents' marginal tax rate. Okay, second thing is unearned income, the remaining amount, still you will take 1250, one more 1250 you will deduct. So standard deduction is 1250 and one more this 1250 will be deducted, which will form part of the child's tax rate, child's marginal tax rate, if the child is liable to file the tax return, okay, based on the criteria which we have seen previously, right? So unearned income, you need to do the calculation like this, and whatever is earned income, straight away it is chargeable to the child's tax rate. Child will receive the same deduction. Okay, so if the child has has a earned income of more than 1250, the standard deduction will be earned plus $400, maximum up to 13,850 will get a standard deduction, and that will be charged at his tax rate. So overall, the conclusion is parent may elect to include their own return. In their own return, they can include the unearned income of applicable child, provided that the income is between 1250 and 12,500 and consists solely of interest, dividend, capital gain and distribution. Means if they have earned income, they will have to include it in the tax rate will applicable is child's tax rate. Okay, so see, up to 1250 is standard deduction. This is, I'm just talking about on earned income. Okay, 1250 to 2500. Okay, up to 2500, like the 1250 which we are deducting from here will be applicable to child's tax rate. Over and above 2500, it will go to the parents' tax rate. Okay, so this was a small confusion which people used to have while studying, while reading the theory part. So I've explained it here very well. Coming back to our normal topic, coming back to our credits chapter. See, we have now understood the criteria of qualifying child and qualifying relative in first chapter. Let's move to the next chapter, that is credits. Okay, so here you can link the topic easily. Just a minute, guys. Income exclusion. Then we have is those who are not having book or whose books is not received, please connect with me. Okay, if you want to buy the book, please place the order in advance, because at least it will take 3 days to reach at wherever location you are located. Okay, minimum 3 days is our requirement for receiving the book. Okay, let's start with the new chapter, that is credits chapter. In credits, there is a bifurcation. Yeah, there is a bifurcation among two categories. One is refundable and second is non-refundable. Okay, refundable credit means whenever you have extra benefit as compared to your income. Okay, let's say your income is $10,000, but due to this credits, you are going to receive a benefit of 12,000. So extra 2000 you will get a refund, that is that is refundable. But if it is a non-refundable credit, even if you have a benefit extra 2000, you will not get a refund, that is non-refundable. I hope everyone has gone through the previous topics. See, this is a revision. I'm just linking the topic from one topic to another. So while solving the MCQs, you should remember those things very well. Okay, this is not a regular class. Don't rely only on revision lectures, right? This thing in detail you have to go through from the regular lectures. Okay. All right. So refundable credits to be shown as a payment on form 1040. Right? Refundable means you will get a deduction, and when you have an extra benefit, extra deduction, you can easily take a refund. Okay. So child and dependent care credit was a refundable credit. Only for 21 it was refundable. Okay. Then we have excess withholding tax. If your taxes are withheld in excess, let's say your employer has withheld extra tax in social security benefit, we have a limit. Okay, 147,000. So more than that, if they have withdrawn or if they have withheld, you can get a refund of it. So you can claim it in the form of excess withholding tax credit. Then we have education credit. Only and only AOTC is refundable, LLC is non-refundable. Okay, then we have as a premium tax credit, earned income credit. This all things are refundable. This will reduce the tax liability and we can claim the refund for the excess amount. All right. Now, what is non-refundable? Foreign tax credit, child tax credit. Child tax is partially refundable. Okay, partially non-refundable, partially refundable. Adoption credit, savers credit, and education credit. Only LLC is non-refundable. AOTC is refundable. So please make sure. Now, important from this are education credit. Child and dependent, child related, all the credits are important. Education credit is important. Premium tax credit is important. Adoption is okay, that's not that much, but yeah, remaining all are very, very important. Please be focused while understanding this session. Okay, understanding this revision lecture. So first we are starting with the non-refundable portion. Non-refundable foreign tax credit. Foreign tax credit is a non-refundable. Taxpayer paid some tax in the foreign country. If they are earning some income from the foreign country, they are going to pay some tax over there based on their rules and regulations, right? Being if a person is US citizen, he's having some bank account in India and has earned a huge interest income, there is a TDS reduction over here for the non-residents, flat 30%, for example. Okay, so while filing the 1040 return, they can go for a foreign tax credit. Whatever taxes they are paid in foreign, they can go for the foreign tax credit while filing the tax return. Okay, to claim this, they need to file from 1116 need to be filed. Exception is if they just have a foreign passive income. Passive means just interest income, just dividend income. Plus they have received 1099 or foreign taxes are up to $300 or $600 only. Then no need to file 1116. This is filing requirement, guys. You can take the credit, that's fine, but straight away you can take a credit on the return. But 1116 is required if you don't have only passive. You might have earned some wages income, right? You might have earned some income on which you have already paid the taxes over there. Okay, if you're receiving 1099, if you're receiving a foreign taxes, if the foreign taxes paid are up to $300 or $600, then you don't have to file the 1116. Okay, now elections to be made on the schedule 3. In previous session we have seen that schedule 1, 2 and 3. What are these 3 for? First is for additional income and additional expenses. Second is for additional taxes. Third is for additional for refundable, non-refundable credits. So election needs to be made on schedule 3. That taxpayer is going to go for total foreign tax credit, or they are going to go for the regular tax, regular credit, regular taxes which is coming, whichever is lower. The calculation needs to be done. They can't take the double benefit, guys. Okay, so you have to calculate what is the total foreign taxes they are paid in foreign country, and same income, if they are going to consider as an income in US, how much should be their tax on that regular income, whichever is lower will be considered. Okay, all right. So no credits available if taxes are paid on income which is excluded from US tax. If you are receiving an income which you are not going to include on your 1040 return and you have paid a tax on that income, then no credit will be allowed on that. Okay, so foreign earned income exclusion, that is the topic we'll do in the F bar last chapter. Okay, so foreign earned income, if you are earning some income and you have taken a benefit of foreign earned income exclusion limit, if you are taking a housing allowance, housing exclusion, okay, if you are earning income from Puerto Rico which are exempt from US tax, okay, or you are taking a possession exclusion, you are earning income from any US possessions, okay, then you are not going to consider for the purpose of foreign tax credit. Even if you have paid credits over the tax over there, you are not eligible for foreign tax credit. Okay, in this topic the only exceptions are compulsory to remember. Okay, the calculation part is fine, you can just understand it once. If you're not able to remember it, that's okay, no calculation part is much necessary. Okay, once we will do the foreign tax topic, there again we will do the calculation. Okay, so there we will have one example to understand it. Next is child tax credit. Now this is important. This is child tax credit is partially refundable. What is the credit amount? 2000 per qualifying child up to 17 years of age. Up to, it is mentioned up to, guys, means you need to remember qualifying dependent topic, qualifying relative topic, qualifying child. It was less than 19, means 18 or less. But for the purpose of child tax credit, it should be 17 or less. Okay, up to 17. So $2,000 per qualifying child. You need to check how many qualifying child you are having. So $2,000 you can take if your child is having the age of 17 years of age. Refundable amount will be allowed which is lower of 15% of your earned income or 1600, whichever is lower. Okay, next one is qualifying child criteria. What are the criteria of a qualifying child? They need to meet all the criteria. First thing is child should be taxpayer's child. Okay, they should not be a cousin or someone else's child. They should be your child. The person can be brother, sister, step brother, step sister will be fine, adopted child, foster child, step child, descendant of any of this child will be okay. Okay, and the second condition is the age criteria. That's why I've taken the credits chapter just after the first chapter, because the age limits are there in this few chapters only. No, none of other chapter will have age limits. Okay, here in case of qualifying child, the age should be less than 16, means can I say, sorry, less than 17, means can I say 16 or less, right? So the child should not pay more than half of its own support, means the child should not be paying, the taxpayer can pay, anyone else on behalf of the taxpayer can also pay. It's not mentioned that taxpayer should only pay the more than half of its own support. Minimum the child should be involved in their own education, own living and all. Okay, they should not take out any expense out of their pocket. This very simple thing you need to remember. Okay, then only they can go for a child tax credit as a credit in the taxpayer's return. Next is lived with the taxpayer. The living criteria is also there. They should be living with the taxpayer for more than half of the year. Claimed as a dependent on the taxpayer. The person should be a dependent on the taxpayer's return. Now, I don't have to again and again repeat the definition. This we have done recently in the last session only. What is the dependent definition? Okay, the person should be dependent, should be child, should be citizen or a resident. If taxpayer pays in advance, then accrual advance payment 50% would be treated as allowed in the current year. Okay, if taxpayer is paying something in advance, right, then let's say the child related expenses for his education, not for education, expenses for his taking care, okay, all those expenses which is paid, the taxpayer pays in advance, then annual advance payment is 50% will be treated as in the current year. Even if he's paying in advance some child related expense, up to 50% can be considered as in the current year. Okay, next is phase out limit. No need to remember the phase out limit. See, people make the mistake in remembering just mugging up the phase out limit, which is not at all important. Okay. If the modified AGI is more than 400,000 or 200,000, okay, the excess of this, okay, this is the maximum limit. Whatever is going more than this, you need to check what is the gap. Okay, let's say your AGI is 4,20,000. Instead of 4 lakh, your limit is your AGI is 4,20,000. So extra 20,000 for each 1,000 excess, your credit of 2,000 will get reduced. Excess amount of 6,000 or 1,600 will reduce by $50 for every 1,000 increase in Maggie. Okay, so this refundable portion will also get reduced, and this 2,000 per qualifying child will also get reduced. Okay, let's see the example. For example, MFJ, Maggie is 165,000. Child tax credit will be 165,000 minus 150. Okay, wait, here it should be 200,000. Okay, so 150,000. Here let's assume that the limit is 150,000. As I mentioned, no need to remember the limits, just understand the calculation part. This much portion is going over and above the limit, okay, Maggie limits. So per 1,000 multiplied by 15 times, okay, multiply by $50 per 1,000, $50. So this much will get reduced from your child tax credit deduction. Okay, clear guys? So you just need to remember the criteria in this topic. This part is most important. They can twist the question based on the criteria. Amounts are not at all important wherever you're going to look at the Maggie limits. Okay, that's why I'm coming up with this revision lecture, because when they buy the book, they just look at the limits and start mugging up the limits. I don't want anyone who is having my book should not clear the exams. Okay, if you're looking the revision lectures twice at least, definitely you're going to clear the exam. Okay, if you don't have that much time, one time look it, but with a very proper concentration. Okay, see, for child tax credit, it will be partially refundable. What are the conditions? What is important? I'm marking it. Please mark it in your book also. Qualifying child criteria is very simple. The child should be your own child, and all criteria should be matched. Meet up. Okay, first one is the child should be the taxpayer child, brother, sister, step brother, step sister, adopted child, foster child, stepchild, descendant of any of them, grandchild, niece, nephew will work. Okay, because the age criteria is also there. So all of this means some of the thing you should be related, like any relation should be related to the taxpayer. The child's age should be less than 17. It is less than means, can I say 16 or less? Okay, the child should not pay more than 50% of their own support. They should live with the taxpayer for more than 50% of the year, claimed as a dependent on the taxpayer's return, and is a citizen and or a resident. Okay, clear guys? How much is the amount of the credit? 2,000 per qualifying child. Out of this, how much is refundable? 15% of the earned income, or 1,600. But please remember, if you guys have seen previously, this refundable was only allowed in year 2021. Now that this is not a refundable credit, I am repeating myself. Please note it down over here. Currently, it is non-refundable. It is just a normal credit where 2,000 per qualifying child will be allowed. Okay, we have seen this in the first when we are understanding. For 2021 only it was refundable. Now it is not. Okay. All right, guys. So moving to the next topic, that is just like a qualifying child, if a person is not fitting under the criteria of qualifying relative, the person is defined under the qualifying relative, not fitting under the criteria of qualifying child, then you need to go for a credit for other dependent. That is straight away $500. Okay, so for qualifying dependent other than qualifying child, qualifying relative must be US citizen, national, or a resident. Okay, anyone who is US citizen, national, or resident, and who is a qualifying relative, okay, qualifying dependent, you can straight away go for $500 as per qualifying relative or as a credit. Okay, other dependent credit, which is totally non-refundable. Clear, guys? Next one is adoption credit. When a person, when you're going to adopt, okay, any child you're going to adopt, and that should be eligible child. The child is less than 19. Now again, the age limit has changed here. Please remember it, okay? If you want, you can prepare a chart where somewhere it's less than 17, less than 18, less than 19, okay, less than 24. So in case of adopted child, the child should be less than 19, means can I say 18 or less, and that child can be US citizen or maybe other than US citizen, right? If the child is in US citizen, US resident, then in that case credit will be available at the time where whether even if adoption is yet to be finalized, okay, the process is still going on, but still you will start getting the adoption credit. If the child is non-US citizen, non-US resident, the credit will be allowed once the adoption is finalized. Okay, all right. Next is amount of credit. How much credit you will get is amount of a qualified expense. What all expense you are going to consider? Yeah, these are the expenses: adoption fees, court fees, attorney fees, travel expense. So these are the expenses which are incurring in relation to the adoption. Okay, consider that minus if you are claiming any qualified expense in prior year. Already you have claimed it in the prior year, reduce that. So remaining amount or 15,950 is the limit. Whichever is lower will be your adoption child tax credit. Okay, if adoption credit, sorry, not child tax. If child is with the special needs, okay, so whatever is your actual expense or 15,950, whichever is higher will be allowed. I hope this much is clear. Okay, now phase out. This 15,950 will start phasing out if your modified AGI is above certain limit. No need to remember the limit. Again and again I'm stressing out. Yeah, this you need to remember. 15,950 is the amount, is the maximum you can get the credit. Or if a person is with a special needs, you can take the actual deduction. Special need means they need some extra care. The person is handicapped or mentally discharged. Okay, so this all things you need to remember, that they can get maximum actual adoption expense or $15,950, whichever is higher. This amount of credit will get phased out based on the modified AGI limit. Okay, whatever is modified AGI limit, the limit is given here, 239, 230. No need to remember, again I'm saying it. No credit is available if Maggie is going above 279, 230. 39, 230 and 79, 230. See, there are certain limits which usually will get changed based on the inflation rates. So next year this will again get changed. So IRS is not going to test you based on the modified AGI limits. They test you on your conceptual knowledge. Okay, all right. Next is, so this credit is clear. I hope everyone is able to understand what is adoption credit. Since this is a quick revision, if you feel that anything is missing, you are not able to understand any particular topic, please drop a message on the comment box. What topic you want me to explain in detail, maybe I can come up if it is required. Okay, see, savers credit. Savers credit is your retirement contribution. When we will be doing the gross income chapter, there we will be having the IRA topic. At that time, you'll understand when you contribute in the retirement plan, if it's a traditional plan or a Roth plan. Okay, certain portion is deductible, certain is non-deductible. For Roth, when you contribute, it is non-deductible. So when you're going to do a deductible contribution, for the same contribution, you will get two benefits. One, you will get the deduction also. Second, you will get a credit, that is savers credit over here. Okay, so based on your AGI, you will get the deduction into certain percentage. Sorry, contribution into certain percentage. Okay, so whatever is your credit over here will depend on your AGI. Again, no need to remember the AGI, that's fine. Form 8880 will be used for considering the calculation purpose. Let's say you have contributed $4,000 into IRA account and you fall under the first category. So 50% of 4,000, $2,000 you can get a savers credit, which will be totally a non-refundable credit. Okay, now what is the eligibility? What all contributions are eligible? Traditional contributions, traditional IRA, Roth IRA, deferrals to 401k. Okay, to 401k, like on behalf of the employees, you are making a 401k deferral deductions. Then you have after tax employee contribution or contribution to ABLE account. Okay, these are the types of contributions which are eligible. Again, there will be a phase out. Taxpayer may not be able to take one of the following is true. What are the conditions? First is if AGI is more than certain limit. 36,500, 54,750 for HOH, 73,000 for MMJ. Okay. If they are claimed as a dependent on the owner's return. They are claimed as a dependent, someone else return. The age is up to 18 years. Still they are contributing for their IRA account. Okay. They will not get the savers credit. This credit is specifically for the old age people who are earning but who are not contributing to the retirement plan account. Okay. Taxpayer is a full-time student, then also this thing is not allowed. Okay. The savers credit is not allowed. Clear, guys? Now next topic is education credit, which is most important. Please remember the criteria very well. One is AOTC credit, which is refundable credit. MFS cannot claim the AOTC if they are filing the MFS status. If they are married but filing a MFS return, then they cannot go for AOTC. AOTC is a refundable, LLC is a non-refundable. Okay, so AOTC, let's start with the AOTC. Maximum AOTC allowed, the credit allowed is 2,500, which is totally refundable. How this 2,500 is calculated? Take 100% of your first 2,000 eligible education expense and then 25% of the next 2,000 eligible expense. Okay, this credit will be allowed per student basis. LLC is allowed per taxpayer basis. This is the main difference, guys. Okay, so people make mistake in this. This 2,500 is allowed per student basis. Let's say the taxpayer and the spouse has 4 children. So 2,500 will be allowed for all the 4 individual taxpayers' education. LLC is allowed per taxpayer basis. Only for one student, allowed for one student. Credit allowed is for tuition fees, books. Okay, we'll come to that point. First, let's complete AOTC. So maximum AOTC is 2,500. How this 2,500 will come? 100% of first 2,000. Let's say you incurred just expenses of $1,500. So 1,500 is within the 2,000 limit. So 100% of 1,500. You will not get 2,500. You need to calculate first 2,000 and next 2,000. You need to segregate. Okay. It is allowed as per the student basis, on per student basis. Okay. Credit allowed is for expenses incurred on books and fees only. Room, boarding expense are not allowed. Same thing in case of LLC. You will see maximum 2,000 is allowed, straight away 20% of first 10,000. Okay, allowed only for one student. Credit allowed for tuition fees, books only if along with the tuition. So here please remember, in class I have given you the example of the IT student. Okay, they get the computers along with the admission fees. Okay, in admission fees the computer expense is already included. Okay, so the whole expense will be allowed. But in case of AOTC, that is not the case. Only books and fees. Even if it comes along with the admission fees, it doesn't come with the admission fees, that doesn't matter. They'll get only the deduction for books and fees. In case of LLC, they'll get a deduction for tuition, books. Books should be only if it is a requirement for that education. Okay. Now AOTC is allowed for the first 4 years of education. Specifically, I can say for higher education. Okay, after completing the 12th grade, you can go for the first 4 years. LLC, there is no limit in the number of years. Even at any age, even at the age of 40, you can start the higher education and go for LLC credit. Okay, now who are eligible? Taxpayer, spouse, dependent. Not allowed if convicted of felony, but else for all of 3 you can go for a credit, that is AOTC. You are expending some amount for their education, then only. Okay, here all the 3 will be eligible. Allowed only allowed even if convicted by felony. Okay, got it? Now here the phase out limit and the phase out limit for AOTC LLC are both same, so you can remember it together. Here you should remember the phase out. Yeah, for AOTC LLC you should remember the MAGI limit: 80,000, 90,000, 160,000, 180,000. The calculation of phase out I have already taught it in the class. Okay, I have already given the descriptive calculation how to do the phase out calculation. Okay, 80,000 to 90,000 is the limit, and for MFJ it is 160 to 180. It will straight away go to double. Now, students should attend the college at least half time of the year. Here is no such criteria for that. Okay, the due diligence checklist is not applicable over here. Here the due diligence checklist is mandatory. Form 8867 needs to be filed because since this is a refundable credit. Okay, and here if you fail to go with 8867, straight away penalty of $600 is applicable. Okay, here it is non-refundable credit. This is refundable, but only 40% of the eligible education credit is refundable. Maximum 1,000. I can say 2,500 into 40%. Maximum 1,000 is eligible for the refund, not more than that. Okay, next is no credit if MFS. If you're filing MFS and taxpayer is claimed as a dependent on someone else's return, you are not eligible to go for a AOTC credit. No credit here if MAGI is more than phase out. See, phase out criteria is there over here also, but there only the phase out criteria is there. Credit will be allowed even if the taxpayer is claimed as a dependent on someone else's return or if they are filing MFS. Okay, so please remember AOTC is little bit restrictive kind of credit. LLC is a kind of liberal credit, I can say. Okay, now what are the qualified expense? Books, supplies, equipments needed for course, whether or not the taxpayer is purchasing it from the institution. Let's say to pursue enrolled agent, I'm going to give you books also. I'm going to give you the iPad also, okay, for watching the lectures and all. Okay, so that iPad cost you can consider in LLC. But in case of, this AOTC, even if the taxpayer is purchasing from me or they are purchasing it from outside, they can consider it as a qualified expense. In LLC, it has to be purchased from the institute only. Only this one thing is a kind of rigid, I can say, thing as compared to other criteria. Other criteria are very liberal. Only one thing is, kind of a thing which is important to remember. This is, they can ask the question based on this. Simply, I'm saying that. And attendance is also important. Here, attendance, everything is not necessary, but yeah, you need to consider books, supplies, equipments needed for the course. Their books, supplies, equipments only purchased from the institution as a partner for enrollment, and attendance is also necessary. Okay, clear guys? So next one is child and dependent care credit. This is again a non-refundable credit. Here you are going to use form 2441. Okay, so child and dependent credit are like for whom if a qualifying child is up to 13 years. Now the age limit has again changed to 13 years. Okay, so child whose age is up to 13 years who is disabled. Okay, disabled means taxpayer provides up to 50% of support. Disabled and taxpayer provides 50% of support. Disabled spouse plus lived for more than half of the tax year with the taxpayer. Okay, so child and dependent credit will be allowed like this. Second is requirement. Both the parent must be working and paying for someone else to take care of the child. So this is the main reason why IRS brought the child and dependent credit. Okay, where if the husband and wife both are working, so who will take care of their child? For them, they have to incur some expense for putting the child into childcare facility, or they have to appoint someone to take care of the child. Okay, so requirement is both the husband and spouse should be working professional. Okay, next is amount of credit. How much they will get? Maximum credit allowed will be 35% of the lowest. What are the three things you need to compare? Earned income of the spouse with a lesser amount. Whoever is earning, let's say husband is earning 10,000, spouse is earning $7,000. So lowest is 7,000. This is your first one. Second is actual expense incurred for the child. Whatever is your actual expense, you need to take that as a condition. And third, if one dependent, 3,000. If two or more, 6,000. 3, 4, 5, 6, it should be 6,000 only, the third condition. Whichever is lower, you have to take 35%, that is the credit allowed. Got it, guys? And for 2023, once you decide whichever is lower, you need to phase out this limit based on your AGI. If your AGI is up to 15,000, credit allowed will be 35%. AGI is more than 15 to 43, credit will start reducing by 1%. Okay, this 35% will start reducing by 1% for each 2,000 increase. And if the credit is more than 43, there will be minimum credit allowed is 20%. It can't go less than 20%. In this chapter, in this topic, this phase out limit is important to remember. Okay, wherever I'm saying it is important, please mark it properly in your book. Wherever I said it's not important, just forget about it. Okay, like if you can, it's good, but if you can't remember, don't stress out on the Maggie limits. All right, so see, this is the thing, amount of credit and the phase out, you need to remember 35% of the lowest. Three are the condition. One is if earned income of the spouse who is having the lesser income. Okay, that. Second is actual expenses which are incurring for the childcare. And third, if only one dependent, take 3,000. If two or more dependent, take 6,000. Whichever is lower, you need to consider that as your credit for a child and dependent care. Okay, 2441 form is used. Now, phase out will start if your AGI is 15,000, up to 15,000, there's no modified AGI limit applicable. 15,000 or more, but up to 43,000, take a difference between that, and for each 2,000 increase in income above 15,000, reduce the 1% from this 35% criteria. More than 43,000, the minimum limit allowed will be, minimum credit allowed will be 20%. It will not reduce straight away to 0. With minimum 20%, you are anyways going to receive the child and dependent care credit. All right. Now, they will have to file the joint return. Married plus if they are filing a MFS return, then it is not allowed. Legally separated or lives apart plus files MFS, credit will be available only to the custodial parent. If they are legally separated, lives apart, and they are filing a MFS return, okay, then only the custodial means who is having the custody of the child, who is with whom the child is living is having the custody of the child. Okay, married plus lives apart plus MFS plus taxpayers home is the home for the qualifying child, qualifying dependent for more than half of the year. Also, the taxpayer is incurring more than 50% cost of keeping up the home. Okay, home. And the spouse and the taxpayer are not living in the same house under the same roof for the last 6 months, then these are the exceptions. Usually they are married plus filing a joint return, then only it is allowed. But the exception are this 3-4 items. 2 items are there basically. One is legally separated plus they lives apart and they are filing a separate return. Credit will be allowed only to the custodial parent. Second is married plus lives apart plus files MFS, and the taxpayer's home is the home for the qualifying child and or the dependent for more than half of the year. Along with this, he should also be providing more than 50% of cost of keeping up the home, right? And spouse and the taxpayer should not be living under same roof. If these conditions are fulfilled, then they can go for child and dependent care credit. Okay. All right. Next is very simple. If by mistake extra withholding has been done, okay, of the taxes, you can get a refund. So tier 1, tier 2. Tier 1 is a social security Medicare benefits. Tier 2 is a pension benefits. Under tier 1, 2 or more employees have withhold your social security taxes in excess of employee compensation wages, which is more than, for 2023, for previous year it was 147,000. For this year it is 160,200. So this is the limit. More than this, if they have withheld the compensation, okay, sorry, they have withheld the social security taxes, or Medicare is fine, there's no limit in Medicare, but social security, if you have withheld more than this, then extra withholding will be allowed as a refund under schedule 3. Okay, and second is pension benefit. Excess withheld amount can be refunded by filing 843 form, claim for refund and request for abatement by the taxpayer. It needs to be filed for claiming the refund. Okay, for both the social security pension benefit. If employee is having only one employee and excess payment is due to the employer's error, you will not get refund due to employer's error. You'll have to amend the return, and you need to ask your employer to provide the refund amount of this mistake, or they can settle it off in the next 941 return. Okay, 941 is basically reporting the taxes to the IRS for the wages taxes, payroll taxes. Okay, so this is the scenario where you can get a refund if excess withholding has been done for the social security. Next is health insurance premium tax credit. Okay, if you have purchased a health insurance coverage, the taxpayer falls under criteria of household income poverty line, and this specific credit is a refundable allowed for individual and families. How much amount will be allowed? Premium paid to the marketplace or advance premium. Okay, what are the conditions? Insurance should be affordable insurance exchange. Credit not allowed if purchased from the outside exchange, or if you're filing a MFS, if you're claimed as a dependent on someone else's return, and if the employer sponsored plan is being given for the health insurance. Okay, it is applicable, the form which is applicable for this is 1095A and 8962, that is premium tax credit. Okay, so premium tax credit are available only to individual and family and household income at least 100%, but not more than 400 of the federal poverty line. Amount of federal poverty line is what? Up to 13950 plus 4720 for each additional member in the house. No need to remember the limits. Again, I'm mentioning the same thing. No need to remember the limits. Okay, in this particular topic. Got it, guys? All right. From here, we are going to continue in the next session. The next topic is earned income credit. From here, we will continue in the next, lecture. Okay. Thank you, guys. Have a good day.